Okay, so today we have chapter 10 accounting rules. All right, 1 second. Okay, so there's a lot of rules in accounting because if there's no rules, it's just that everybody is gonna have their own rules. So it would be like, me having a business, me being an accountant, and then I'll just do whatever I want, and then I'll make my profit $10 million. My losses will never exist because, you know, and then I'll flex people that, hey, look, I made a $20 billion sale, even though it's not there. So, that kind of stuff will probably happen. So that's why we need rules. There's other reasons as well, because the reasons I just said right now, they're not really things that happen in real life. Anarchy accounting, what's that? Anyway, so yeah, the reasons for the rules are a bit more realistic, but yeah, we're gonna be going through a business entity. These are like all the principles we will read today and learn. And then there is the international accounting standards thingy. All right, and then there is capital expenditure and revenue expenditure, capital receipts and revenue receipts. We'll go through that as well. And then incorrect treatment of capital expenditure or revenue expenditure, and mixing them up, like mixing these four up. What will the effect be on the profit, and what will the effect be on the asset valuation? And then we'll learn about inventory valuation of inventory, and we'll make some inventory valuation statements. Then we will read why inventory valuation is important. So you can see that most of this chapter is theory, okay? Now they don't really ask 5 marker theory questions in this chapter. It's mostly mixed with normal questions, and there's like 1 or 2 mark questions, and there are a lot of them. Okay, we can make that, but like we won't be able to flex our accounting, our records to other businesses because they have to use this international accounting standard. So if you're making some anarchy accounting, like no rules, then you're gonna have to keep that to yourself. All right, introduction. Now, just the same thing what I just said, accounting has a number of rules must be applied with everybody who's recording the financial information. Because if everyone used their own rules, it would be impossible for someone else, like who does not know those rules, to understand the financial position of a business. So if I'm, let's just say that I'm a businessman and I'm making my own accounting rules, and I tell people that in my business, in my accounting records, I will also put my house as an asset. I will also put my rent in the business expenses, like my house rent and stuff. I will put my, I don't know, shopping expenses and everything in the same accounting records. So not every business will think the same, and not every business will do that. That's why it's going to be, harder to harder to compare, make a comparison between the two businesses or any more businesses. Okay, because if they're using their own rules, then it's going to be difficult. The accounting principles are explained in this chapter, which every business must apply. So if you're, if you're making a business or like if you're doing accounting without the rules, then you probably won't be able to compare your business with anybody else, at least not easily. Okay, and then we're going to read about, wait, what? Yeah, then capital expenditure revenue receipts should be recorded, and every business should follow the same concept for them, because if you mix these up, there's going to be a huge difference in your profit and your assets. Okay, we'll learn about them as we progress. Okay, and then inventory valuation also, all businesses should apply the same thing, because if it's not, then some businesses, like comparison won't be easy. Okay, in addition to learning the names of the principles, you must be able to explain and provide examples of each principle. Okay, so this is really important because in your MCQ, sorry, in your past papers, in your questions, they pretty much ask you this. They normally just ask you the definition, but sometimes they can ask you this kind of stuff, like just give an example of prudence, or they're gonna give you a table and they're gonna be like, this is a few cases. Tell me which one is prudence and which one is this, like that. All right. So accounting principles, accounting concepts, accounting conventions. A concept is a rule which sets down how the financial activities of a business are recorded. So just accounting principles is just giving the definition of it, okay? And then a convention is an acceptable method by which the rules apply to a given situation. Some of the main accounting principles have already been applied to the practical accounting examples in the previous chapters. So as we progress, we will know that some of the rules have been applied. So there's this rule of duality, like there's this duality principle. which means that every transaction should be recorded twice, which is basically double entry bookkeeping, right? And we did that in chapter 2. So in that way, like a few things are going to be repeated, but it's all easy. That business entity is going to be our first principle, and we have like a lot of principles, this much. And then we have the accounting standards. Then we're going to go for capital expenditure, revenue expenditure, capital receipts, revenue receipts, and then inventory valuation, and that will be the end for this chapter. And if we have time, we will start this. If we don't have time, we might, yeah, it's boring, boring. If we don't have time, we might just, leave it for Sunday. Because this chapter is also big and that chapter is also big, so it might be hard to cover it both in one day. So business entity or the accounting entity is that the business is someone else and the owner of the business is someone else. Now, as I gave that example before at the start of the class, I was like, if I am an accountant and I also put my house rent and my shopping expenses and my normal day-to-day expenses in my business, it's not the right thing to do, okay? According to the rule of business entity accounting, according to this rule, let's read what it says. It means that the business is treated as being completely separate from the owner of the business. The personal assets of the owner, as in like if I have a whole building or something, I can't record that in the statement of financial position of my business, okay? It's separate. My business is something else, my building is something else, all right? Because that's my personal asset. The personal spendings of the owner, if I'm going for shopping, I won't really record it in the business. Sure, if you're taking drawings, and that's a different case because you're taking out stuff from the business, so you're still connected to the business. You're taking out stuff, that's drawings. You're putting in stuff, that's capital. We record that in the business. They have also mentioned it where this thing like the capital and about drawings, makes drawings and introduces capital. So these are both common things, like that they're connected to the business. But if it's your personal spending or personal assets or personal whatever, you don't need to put them in the accounting records. In fact, you cannot put them in the accounting records. It's against the rules, all right? Because let's just say you have a Bugatti, but it's not part of your business. Now, if you put that in your statement of financial position, you're suddenly a very big business. But that's not exactly the case. Is it like this for sole traders? It's like this for every business. We just read it over here, right? That number of rules which must be applied by everyone who is involved with the recording of a financial information. So this means that even a small supermarket and even Apple or any big company, whatever you can think of. All right. So yep. Then okay. That's it. Accounting records only relate only to the business and records of the assets of the business, the liabilities of the business, the money spent by the business. Everything in the accounting records is about the business. Okay, business entity, like the business only. Okay, so you don't put your personal stuff. You keep that separate. The practical application of principle of business entity has already been explained in chapters 2, 4, and 9. Probably. You see, like this is telling how everything is connected in accounting. That's why accounting is really good. If you understand the basic chapters, you understand everything except for theory, because like you have to go through that yourself. That's why theory is not very fun. Okay, the next principle is consistency. So sometimes, like for depreciation, for example, you have methods, you have different choices. There's three methods for depreciation. Now the consistency principle goes like, if you choose one method, then you stay consistent with it. You don't change the method every single year. Okay, so let's just say that I take the straight line method of depreciation for my machinery. Now I cannot be like, yo, this is costing me a lot, I think I'll change to the evaluation method. You can't really do that, okay? Consistency principle means that accounting methods must be used consistently from one accounting period to the next, okay? You can't change your depreciation method just because you feel like it. If you chose it once, it's your fault for choosing the wrong one, but you use that. The most realistic outcome should be selected. So, for example, if you have a car, then you will depreciate it using a reducing balance method. I think I'll just stop there because I won't really speak much about depreciation right now. It's chapter 12. We are on chapter 10. But once we get there, I guess it will make sense. All right, must be used consistently. You should not change the method. That's consistency principle. Because if you do change the method, what's the outcome? Like, what's the consequence? Is that you will hardly be able to compare from one year to the next year because the profits are going to be different. If you're using straight line method, you will get like 5,000 depreciation per year, and if you use reducing balance method, then you will get more depreciation in the early years. Okay, so that's why it's a bit different. Now, sometimes, where you need to change it, you're allowed to, but it's not like you should make it a practice. Or when there's no reason, you're just feeling like it, you don't really change the method. But when there is a necessity or a valid reason, like when it's necessary to change it, or if there's a good reason, you can change it. But of course, there's gonna be consequences. There's consequences, so you're gonna have to adjust for that. We don't really have to do this kind of stuff in IGCSE because they don't really change it like in the question, but they can ask you to, give the theoretical answer. So what's business entity is that business is different and the owner of the business is different. In your business, you record only stuff that's related to the business and not your personal assets and everything. Why a business should apply the principle of consistency in order to make comparisons easier and to keep the profit for the year, not to keep the profit for the year from distorting, I guess. All right. Then we have duality principle, which is just your normal double entry. Okay, let's just read it. Also referred to as the dual aspect principle. It has been explained in chapter 2, how every transaction has two aspects, a giving and a receiving. So you know how you do debit, credit the giver, debit the receiver. That's double entry. That's duality principle. And then the term double entry is used to describe how these two aspects of a transaction are recorded in accounting records. Okay, very easy. Then going concern, this is that. Okay, this is a bit tricky. Like you will have to remember this sometimes. Like only once, I have only seen it once in the past papers. They gave a tricky question for this. Okay, the accounting records of a business are always maintained on the basis of assumed continuity. This means that it is assumed that the business will continue to operate for an indefinite period of time. As in, like you don't really plan to close the business right now. Okay, there's no intention to close the business or reduce the size of a business by any significant amount. As in, you don't like let's say you have $10 million capital, let's just say. Now you don't intend to make it $1 million in the next year. You just, if it happens on its own, like maybe it becomes 9.5 million. Okay, that's okay. Maybe we made a loss, a huge loss. But unless like the going concern principle means that there is no, you don't really plan to close the business. Okay, and because of this, like since you don't plan to close the business, your assets in your statement of financial position will be recorded at their book value. Okay, this is net book value. We'll learn this later, like in your depreciation chapter, but they have given a small definition, you can say, which is the original cost less depreciation. So the total depreciation charged on the asset, you're gonna subtract that from the total cost. So let's just say you bought the asset for 5 million or 500,000 and you have depreciated it for 100,000. So the net book value would be 400,000. Okay, like this is the actual value of the asset. But if you are planning to close the business, like if it is expected that the business will cease to operate in the near future, then you will value the assets as their sales value, like at their expected sales value. So this is worth 400,000 according to me, but in the market, like let's just say there has been, after I bought this, the value of this asset increased to $10 million. Okay, or $1 million sounds more realistic. $1 million, and even though I depreciated it all that, it's 400,000, but the market value for this would be like $600,000. So I will now value it at 600,000 instead of 400,000. Why? Because you have to, you know, the sales value is more meaningful at this point because we are trying to close the business. So when you close the business, you want to sell all of your assets, and that's why you, you know, say that my statement of financial position, my business right now is standing at this stage. Okay. So there's just one exception. Other than that, you will always value the stuff at your book value. And the exception is that if you're trying to close the business, then you will, record the stuff in the financial statement, in the statement of financial position, as their expected sales value, at their expected sales value. Then we have historic cost. Yo, if any one of these doesn't make sense, because like my teaching right now isn't going so nice, just ask a question, okay? It'll probably help the people relying on the recording as well. Anyway, so historic cost means that all assets and expenses are initially recorded at the actual cost. So just how I said right now, like we bought a machinery for 500,000, but after we bought it, something happened and now the machinery is worth $1 million. Okay. So you don't change the value of this machinery in your statement of financial position to 1 million. You keep it at 500,000 because this is the cost at which you bought it. Okay. That's the historic cost principle. Requires that all assets and expenses are initially recorded in the ledgers as their actual cost, at their actual cost. And it's very much similar to money measurement principle, which we're going to study over here, like in a bit. All right, applying this principle makes it difficult to make comparisons about transactions occurring at different times. So let's just say that, I bought this machinery for 500,000 now, but next year I buy another machinery. It's the same thing, it's just worth $1 million. So it's kind of weird, because inflation happened and it makes it difficult to make comparisons. It's gonna feel like, yo, this machine is worth nothing, but this machine is worth the same as this. Still, we record it at this price because cost is a known fact and can be verified. They should have probably elaborated more on this. Elaborated more on this. I don't even know what it means. Like, you can just probably copy this in the exam. And then we have this, the cost price is reduced by depreciation, but like that's more of prudence. Okay. Matching principle is also referred to as the accruals principle. Today, like not today, but whenever we do chapter 11, the chapter next to this is about accruals and prepayments. Matching principle is like the most important thing there. Okay, if you understand this principle, that chapter will be easy for you, and if you understand that chapter, this principle will be easy for you. They're connected. Okay, so matching principle is also referred to as the accruals principle, and okay, the revenue of an accounting period is matched against the costs of the same period. This is the definition, you could say. Means that the revenue of the accounting period is matched against the cost of the same period. All right. Now, that's what we read and that's what we see. Okay, but like an example would be, let's just say I have, I don't know, I have an expense. All right, it's say electricity, sure, electricity, and it's 1,000 per year. Okay, $1,000 per year. Now I decide to not pay at all for like the past 5 years. Okay. Does this mean that I won't record electricity in my income statement when I'm recording all of my expenses? I will still record electricity because it's an expense for the year. I just didn't pay it, right? But it's still an expense. It will reduce my profit. Maybe not this year, but one year. Okay. So even though I didn't pay it for 5 years straight, I will still have it, 1,000 in every income statement for all 5 years. This is year one, year two, year three, year four, year five. Each one of them will have 1,000, 1,000, 1,000, 1,000, 1,000. That's basically what the matching principle is. Is that everything that is related to this year. So this electricity is related to this year. It's gonna come here. 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 Even though I didn't pay it, or even though if I paid extra for 5 years, I won't record it all in one income statement. I will put it all appropriately, like, this 1,000 for year one, I'll put it for year one. Let's just look at the example they give. The timing of the actual receipts and payments is ignored. So if you're having an income, if it's an income account, let's say commission receivable or something, it doesn't matter when you receive the money. It matters that what matters is what year the money relates to, and you're gonna put it in the appropriate year, like in the income statement of the appropriate year. Okay. The figures shown in an income statement must relate to the period of time covered by that statement. Meaning, like, if you have this electricity, then it should relate to the period of time covered by that. Sorry, yeah, it should relate to the period of time covered by that statement. So let's just say that this electricity is for the year 2020. Okay. So this income statement is for the year 2022, and that's 2020 as well, and that's why you're gonna record this electricity over here. Okay, does that make sense? Probably does. The figure shown, this 1,000 figure shown in the income statement, must relate to the period of time covered by that statement. This is 2020, and this 1,000 is also for the year 2020. All right. Whether or not any money has changed hands. I have not paid this, but I'm still recording it because it's an expense for that year, right? This means that a more meaningful comparison can be made of profit, sales, expenses, and so on from year to year. Okay, I'm pretty sure that this part is common sense and like everybody understands it. In chapter 11, you will learn why it's necessary to adjust the items of income and expenses in an income statement for amounts prepaid or accrued. Accrued is like owing. So for example, if you say accrued income, it means that you owe, like people owe you income. And if you say prepaid income, that means that people paid you in advance. And then for expenses, the same thing. Prepaid expenses, like you paid the expense in advance. And accrued in expense is that you owe the expense. So like this right here, I haven't paid it for 5 years, is an accrued expense. Okay, but I'll still record it in my income statement, even though I didn't pay it. It relates to that year. It will come there. Next, we have the matching principle. Next, we have the materiality principle. This is basically like anything that's very low value. Say I buy a pencil and I use it for my business. I don't really need to make a pencil account and then record it anywhere. You don't need to do that. Even though pencil is an asset, even though it's non-current asset. It's not meant for resale, and but it's not meant for resale, and it's gonna help the business earn money, but still you won't record it as a non-current asset in your statement of financial position because it's too cheap. Okay, so materiality principle applies to items of very low value, which are not worth recording as separate items. Other principles can be ignored if the time and cost involved in recording such low value items far outweigh any benefits to be gained from the strict application of these principles. Now tell me what's going to happen if I make a pencil account, and then in my statement of financial position in my non-current assets I write pencil, and then I write like $2 next to it. This doesn't make any difference to my statement of financial position. I mean, it does make a difference. It makes my statement of financial position $2 stronger. My non-current assets are $2 stronger. But does that really make a difference? Does that, like, the costs involved, so if you want to record such small items, you're gonna have to pay your accountant more. Your accountant is gonna be like, bro, what are you trying to do? I need more money for this. I don't get paid for this. So your accountant is gonna take more money, and that's gonna make like increase your costs. So is it really worth it? Does this $2 outweigh the benefits to be gained? Okay. And then also, like, do you have to apply other principles? There's your prudence principle down here, which states that you should not, one second, where is it? Prudence is that you should not really understate your assets or income. So you can't just understate this $2. You will put it in a different place. You will put it in your stationery account maybe, or your general expenses or something, but you won't really record it as a non-current asset. Okay. For example, a pocket calculator purchased for office use is strictly a non-current asset, part of its value being lost each year through normal usage. Like depreciation will be charged on your normal calculator, but sorry, depreciation exists even on your calculator, but you won't charge it. You won't, have a whole depreciation account just for your calculator and everything. You don't need to do that. That's like pointless, right? It's a $2 pencil. You're depreciating it by $0.5 each year. Wow. All right. It will be regarded as an office expense in the year of purchase. What is material? Now they're just saying this, like it's separate from that stuff. What is material for one business is like what is cheap or not worthy of being recorded for one business may not be so for another business. Now let's say that it's a very big company, and they just buy a printer and they don't really care. They don't really count it as something worth depreciating and writing separately. But there's a small supermarket, and they buy a printer, and now they have a whole, like, their statement of financial position is twice as strong because of that non-current asset printer. Okay, they have given an example here. A laptop computer may be regarded as immaterial for a large multinational business, but would be material for a small sole trader, because that small sole trader doesn't really have that much money. A $1,000 laptop is a lot of money for him, but the large company is like just $1,000. It's next to $2 for them. Okay, because they're dealing in millions and stuff. Okay, may decide that non-current assets costing less than 1,000 will be regarded as immaterial and be charged as expenses. All right. So a small businesses would have like maybe $10. Anything below $10, any asset below $10 will just be an expense. So if you buy paper, printing paper or anything, you will just record it as expense and not current asset or non-current asset. Okay. This principle is also applied by entering small expenses in one account known as general expenses or sundry expenses. So instead of making a whole pencil account, you're gonna put your general expenses account, and you might have pencil or stationery over here in the debit side. Okay, because that's just faster. Materiality is also applied in relation to inventories of office supplies like envelopes, when the total cost of envelopes is treated as an expense. So even though you have some left, you don't really make an envelope inventory or just a separate inventory account or treat envelopes as an asset. Instead, you just put them all as an expense. It doesn't really matter much, right? Like $5 expenses, maybe $10, but how much can it be? So it doesn't really matter a lot. That's why you don't put every single thing. You just put whatever matters. Explain how the principle of duality is carried out in recording day-to-day transactions. Just double entry, uh, giving and receiving sides. State one situation when the principle of going concern is not applied, when you are intending to close your business, because going concern said that there is no intention of closing your business. But if you do expect that your business will stop operating, then of course you don't follow the principle. Explain what is meant by the matching principle is that income and expenses of the year will be like recorded of in that year's income statement to match the revenue. The matching principle means that the revenue of the accounting period is matched against the costs of the same period. Meaning, like if you have, if you're making your income statement and putting sales, let's say, then you won't put your expenses of all other years. This is like my past 5 years expenses, right? And I make a 2025 income statement, and here I'm making some money. Just say 20,000, right? Is that, yeah, 20,000. Now I won't put all 5,000 expenses here. In this year, this is 2025. I only earned 20,000, and I only like deserve, or you could say, in this year only 1,000 of electricity was charged. So I'll only record 1,000. I won't record the previous stuff. I won't record the future stuff. I won't record anything, but everything that's like for this year. Very cool. Explain why the principle of materiality may be applied to the purchase of an office stapler, because it's of very low value. The office stapler does not bring any change, does not bring much change to the statement of financial position of the business, and it can be treated as an expense. It doesn't really matter. Did we read prudence or money measurement? All right. Money measurement means that only information which can be expressed in terms of money can be recorded in the accounting records, and it's pretty much like it's simple to understand. It's not a hard definition. It's literally as it says. So, for example, if in my business, they have given a few examples: the morale of the workforce, the effectiveness of a good manager, the benefits of staff training course, they won't appear in the accounting records. Can you, or let's just say loyal, what do you call it? Can you say loyal employees? Like hardworking employees and all of that stuff. You can't really say my employees loyalty is $200,000. Doesn't really make sense, right? You can't say that my the benefits of my staff training, or you can say that my staff is experienced $200,000. That doesn't make sense. Like you can't record this stuff in terms of money, and that's why you will not record it in your accounting records at all. If you say that I have many loyal customers, sure, that does make sense. But if you say I have $50,000 loyal customers, what do you mean $50,000 loyal customers? That doesn't make sense, right? So you cannot express this stuff in monetary terms. That's why you will not record them in the accounting records. You will only record stuff that is, you know, uh, sorry. You can only the money measurement principle means that only information which can be expressed in terms of money can be recorded in the accounting records. All right. And then just this was the good stuff, there's also a bad stuff. If you have increased competition or any other negative thing, you can't record that also in your accounting records, because that cannot be measured in monetary terms either. And then you have your prudence principle. Like literally, the prudence principle by definition is that profits and assets should not be overstated and losses and liabilities should not be understated. But then they say here that the exercise of prudence does not allow the deliberate understatement of assets or income. So you can't just be like, okay, I cannot overstate my assets according to this, but I can probably understate them, right? You can't on purpose understate them, but like if they do get understated by mistake, okay, I mean, it doesn't matter. But if you're overstating your assets or your incomes, then it can, or your profits, then it can create a wrong image, like a false image. You're going to think that you made a lot of profit, and then you will make a wrong decision. You'll be like, okay, let's invest all of this, but in reality you had no profit. All right. Similarly, you should not overstate, losses and liabilities should not be understated. If you're making a loss or if you have any liability, you should not understate them. If you understate them, you're gonna again have a wrong image. You're gonna have a false image. You're gonna feel like, okay, I have zero liabilities. Now I can probably invest all my money elsewhere, or I have cash. I have to pay back my liabilities. But since you don't know about these liabilities, you understated them because you didn't follow the prudence principle. You end up wasting your money somewhere else, and then you have bad relations with your suppliers because you don't pay them their money and stuff. So that's why this principle is important. But then again, you don't deliberately overstate your liabilities or expenses. Okay. So in short, prudence does not permit bias. So basically, it's just saying that whatever you record it properly, and don't make stupid mistakes. In short, accountants should ensure that profits and assets are not overstated and the liabilities are not understated. The phrase sure, 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 profit should only be recognized when it is reasonably certain that such a profit has been realized, and all possible losses should be provided for. Okay. Now this is I agree with this a lot. Prudence is really important, and mostly in MCQs and stuff, and like even your normal exam questions, If you do not know any answer and like the question is about principle, and if you absolutely don't know anything, then just write prudence. Probably 80% of the time the answer is prudence. It's either prudence or it's either matching principle. That's mostly what they ask. If a situation arises where applying another principle would be contrary to the principle of prudence and the prudence principle is applied. Bro, this is, when I read this, I was like, this chapter is BS. This chapter is a lot of yeah. Anyway, here, yeah, they've given a nice example. Under the realization principle, what's the realization principle? Okay, we didn't even discuss it yet. This thingy. So it's just saying that you will only record income when you actually earn it. Sorry, you will only like record income as earned when the legal title to goods passes from the seller to the buyer. So let's just say that I am a consumer, I'm a businessman here. This is me, and then this is some other guy, whatever. He buys goods from me, I give him goods. He gets the goods. Like when I record an invoice, when I write an invoice to him or anything like that, the goods are legally his. Now I can say that I earned this money, okay? Before that, I cannot say I earned this money. If he takes the invoice or if he takes the goods, sure, it's his. It's legally his. But if it's not, then we won't record it as revenue. It's not sales yet until the legal title of the goods passes from me to him, right? Let's read what they have to say about it. Emphasizes the importance of not recording a profit until it has actually been earned, and they're comparing prudence with this. But let's just finish the definition of this first. This means that revenue is only recorded as being earned when the legal title to goods or services passes from the seller to the buyer, who has then an obligation to pay for those goods. So if you send an invoice to your customer, what does he have to do? He has to pay you money, right? Now the goods are his, the money is yours, okay? And that's why you record it as a revenue. Like that's why you regard it as revenue because you already earned this money. Legally, it's yours. He already got the goods. Legally, it's his. Even though the goods are still are in your warehouse and the money is in his bank account, okay? When an order is placed by a customer, no goods change hands and no profit is earned. Profit is regarded as being realized when the goods actually change hands. Okay, yeah, thank you. Thank you for saying this. If you're selling on cash, then this credit thingy won't happen because this was the invoice stuff, but they've told about credit as well. This is the same even if the goods are sold on credit and the customer does not pay for them immediately. So just as I said, and then for cash it's different, is that you will only record the profit or the income when you actually get the money and when the guy actually gets the goods. Okay. Now back to prudence, this example. Uh, the realization principle down here said that profit is earned when goods actually change hands, right? So let's just say I gave goods to a person. This is me. He got the goods. I didn't get the money. I didn't get the money at all. He's not giving me money. It's been 3 years. And he just ran away. He went to a different country. The principle of prudence may be applied and the debt is written off. Instead of waiting for his money anymore, like I've waited for 3 years, this was his money. He did not pay it. So I'll record it as a bad debt. Okay, I did not receive any money, but I'm finishing his account. I'm closing it. All right. So I'm saying that instead of recording it as an income, I'm recording it as an expense. And this is why, like, I'll explain why the prudence principle is being used here, as it said that assets should not be overstated. You know that the guy has gone to some other country and he hasn't paid for 3 years, and he definitely will not pay us anymore, right? He's gone, he left us, he's not paying this money back. So you can say that if you keep this recorded, like if this is trade receivable, say this is $100, your trade receivables are $100 only, and he's the only trade receivable you have, but he's in some other country, he's in Antarctica and he died there. He passed away, nobody knows about him. Are your assets being overstated or not? Of course they are, because this $100 you will never get them. They're not exactly your trade receivables. You can't get them anymore, right? Because the guy is dead, he died. So that's why you record this as a bad debt or a debt written off, and you say, okay, bro, I'm not receiving this $100 anymore, and that's how you not overstate your assets, and you use the principle of prudence. Okay, even though you didn't get the money, and even though realization principle it's going against it, but prudence is very important, and it's like, uh, where is it? Situation arises where applying another principle, then the prudence is applied. All right. No entry is made in the accounting records of Park Street Stores when a competitor reduces his prices by 15%, because the competitor reducing prices cannot be measured in monetary terms. This is the money measurement principle. The launch of a rival product or increased competition cannot be recorded in the accounting records as their effects cannot be measured in monetary terms. All right, if in doubt, understate profits and overstate losses. Oh, okay, that's kind of smart. This is also prudence. When they say understate and overstate, both of them, like it's always prudence, okay? Because prudence is the only thing that cares about, keeping your accounting records free from bias, not overstating and not understating stuff. A customer orders goods on 2 February. This is the kind of questions that will come in the exam also, by the way. Like they can probably ask it. Like they're gonna give you examples like this, and then you have to tell what principle it is. Explain why. No, but like I already did kind of. A customer orders goods on 2 February. The goods are delivered on 16. A check in full settlement is received on 28. State which date. My stylus is going crazy. State the date on which the revenue is regarded as realized. Give a reason for your answer. This is a check, which means the guy bought goods on credit. I think the answer is this, but I'd probably be wrong. Let's find out. I have a I have a very good feeling that I'm wrong. A very strong feeling that I'm wrong. Give me a minute. Don't tell me I have to log in. Okay, 1 minute. I'll check the answer. Okay, this is what? Okay, this is chapter 11, chapter 10, chapter 9, chapter 10. Instruction 10.4. Regarded on 16th February. Yes, I was wrong because revenue is regarded as realized on 16th February. This is the date that the legal title to goods passes to the customer who has an obligation to pay for those goods. Oh, okay, wow, that's kind of good. All right, so they basically said that it's gonna be 16th February because we give the goods to this guy at 16th February, and only after 16th February he has to pay us the money. Like he has to pay us the money because he got the goods. But before that, he could have just been like, "Nah, man, just keep them with you. I don't want to give you the money," and we would have been like, "Okay." So I guess that makes sense. All right, now international accounting standards. Oh my God. Like mostly in MCQs, they just have one question for this, and it's like question number 35, like the last question or something. All right, there are one or two questions at max, and this barely comes in paper one, like paper two, sorry, like the theory paper, the big paper. Okay, so international accounting standards ensures that financial statements prepared using same rules and guidelines internationally, because international standards. Knowledge of the individual accounting standards is outside the scope of the syllabus, meaning that you don't really need to care about individual accounting standards. You only need to care about international accounting standards for now in IGCSE. The objects of standards are to ensure that users of financial statements are protected and not misled, meaning like if I have a statement of financial position, some random company gives it to me, so I have to, like I am the user in that case, and I have to be protected and not misled, meaning that the information should not be wrong. Okay, so these are some rules set by the International Accounting Standards, the IAS, and we're gonna go through them. All right. The quality of information contained in financial statements determines the usefulness of these statements. The quality can be measured in four factors: comparability, relevance, reliability, understandability. Okay, a lot of ability. Now, comparability. The information can be useful if it can be compared with similar information about the same business or about compared with other businesses. Okay, so basically that your information has to be good enough to be able to compare it. In order to make comparisons, it's necessary to be aware of any different policies used in the preparation of financial statements. I don't even know what to talk about this, bro. Should I just read it? I think I should just read it. It's not bad, but they're not easy either. You can easily get tricked if you don't know what you're looking for. Don't expect the lesson to last this long. Was this That's the problem, and also this is it's just too boring of a chapter, you know. But it's okay. We have to do it either way. I think I'll just read this, guys. I'm sorry. The information contained in financial statements can be useful only if it can be compared, like not only if there's other three reasons, all of them have to be, like all of these factors have to be completed, you could say, for the quality to be very nice. All right, can be compared with, okay, for another accounting period or at another point of time. So let's just say this is my business in 2020, my income statement in 2020, and this is my income statement in 2025. They both should be like nicely done that I can compare them both, and that's basically the objective of comparability. Now, how can I make them nicely? It's necessary to be aware of any different policies used in the preparation of financial statements, any changes in these policies, and the effects of such changes. So, if I'm changing anything from 2020 to 2025, I have to like know them, and I have to know the effects of them, and that way I can compare nicely. Okay, does that make sense? It is important to be able to identify similarities and differences between the information in financial statements and information relating to your accounting periods or other businesses. Okay, very nice. I don't even know what you're trying to say. Alright, now relevance. Financial statements provide information about a business's financial performance, motion, and position. These can be used as the basis for financial decisions. All right, so if you have your income statement and it says that you made like 20,000 profit, what are you going to decide? You're going to decide, sure, let's reinvest this. If it says 20,000 loss, what are you going to decide? You're going to decide, sure, let's close the business. So based on your financial statements, you can make decisions. These can be as the basis for financial decisions. Now it's important that the information is provided in time for these decisions to be made. Information not available when required is of little use. So let's say that I have to decide on if I want to pay my suppliers or not, but my statement of financial position is not ready yet, and I don't know what my cash or bank balance is. And now my suppliers are getting angry, and each one of them is coming to hunt me tomorrow night, and then I'm gonna have my last sleep or something like that. So because of that, you should make sure that your information is provided in time, because if it's not, it might lead to something not very nice, right? It's of little use. It's also important that information is relevant to users of the financial statements. Users of the financial statements, meaning like if I give my income statement to some random guy, the information should be relevant to the user of that, to that random guy because he's the user of financial statement. This means that can be used to confirm or correct prior expectations about past events and also help performing, revising, or confirming expectations about the future. Okay, what the heck? I don't even know what this means anymore. Information is relevant to users of financial statements. Okay. Means that can be used to confirm, correct prior expectations. Expectation about confirm or correct prior expectations of past events. I don't even know if they're talking about the business over here or if they're talking about random people who will use the financial statement, like your bank or something like that. Okay, say we talk about bank. Never mind, I don't want to say anything. Business, no, bro. This is accounting, and I don't know what I'm saying. Hmm. Guys, can you stop yapping? I'm already angry enough. Like pissed off in this. 'Cause it's just a weird chapter. Anyway, this just means like relevance is just that the financial information is relevant to the user. Say if I'm giving my financial statement to a bank, the bank should be able to use it to confirm or correct prior expectations about past events or help forming, revising, or confirming expectations about the future. Now, say if my bank wants to give me a loan based on my balance sheet, based on my statement of financial position, they will decide whether they have to give me a loan or not. If they see my liabilities, they will decide whether they have to give me a loan or not. So if my liabilities are really high, they're gonna be like, yo, this guy doesn't pay his liabilities. So they're gonna be like, no, not giving you the loan. And if my cash is really high, they're gonna be like, okay, he'll definitely be able to pay us the loan. So that's why they're just gonna pay you the loan. So yeah, I guess that's it. All right, then we have reliability. The information provided in financial statements can be reliable if it is free from bias, free from errors, prepared with suitable caution, being applied to any judgments and estimates which are necessary. I don't know what this means. Capable of being depended upon users as being a true representation of the underlying transaction and events which is representing. I don't know what this is. Capable of being independently verified. I don't know what this is. I'm just bored right now, bro. This chapter is bad. Well, free from significant errors, as in like if you have 20,000 profit, then you shouldn't write it as 2,000. You should write it as 20,000. You shouldn't have some crazy errors. Free from bias, as in you shouldn't overstate or understate your random things. Okay, you should keep it all perfect. The prudence principle. Capable of being independently verified. Your income statement or your balance sheet, they should be good enough to be independently verified. Yeah, more or less. Capable of being depended upon by users as being a true representation of the events and transactions which it is representing. So if I have my income statement right here, and in this I write a $20,000 loss, sorry, 20,000, yeah, loss, this is it. Then in reality also I should be having a $20,000 loss. Okay, it should be like people who are using the income statement should be able to depend on the income statement to get a representation of the transactions and events which the income statement is representing. So let's just say this is for the year 2020. So looking at this income statement, I should be able to get an idea of what was happening in the business in the year 2020, I guess. uh, I don't know what this means. Okay, epic. Ta-da. Understandability. It is important that financial statements can be understood by users of those statements. This depends partly on the clarity of the information provided. It also depends on the abilities of the user of financial statements. This much understandability is just that if I'm making a financial statement, people should understand it, right? But it doesn't really depend on me that people should understand it. People should know how to understand it. So this depends partly on the clarity of the information provided. It doesn't depend completely on my financial statements. It also depends on the ability of the user of the financial statements. If I'm giving my financial statement to my bank, the bank should know how to use it. It depends on his ability, on their ability, and it depends on the clarity of my income statement. So like if I'm putting my entire income statement in one column, it's gonna be a bit weird and it's gonna be hard to tell what's going on. But if I keep it clean and I distribute it into three columns and you know keep everything separately and nicely, it's gonna be a bit easier. All right. It is normally assumed that users of financial statement have a reasonable knowledge of business and economic activities and accounting. Now, please remember this line because in MCQs they ask you this, like they straight up ask you this, and remember that it's reasonable knowledge and not no knowledge or not full knowledge. It's reasonable knowledge. That's it. It's reasonable knowledge. This chapter 10, principles, accounting principles and stuff. Which accounting rule doesn't appear often in the exam? I mean, you will barely see. Let's see how many rules there are. Hmm. The realization principle doesn't come a lot, but when it comes to public cooked, then the material, yeah, most of them, like they ask, they mix them up. Historic cost is also a bit rare, but like it can come. Mm, going concern, same thing. Duality, consistency, matching, and prudence. These are like very popular, okay? Duality, consistency, matching, and prudence. Duality is double entry, so if you get that, it's just a free mark. Don't get that wrong, please. Alright. Uh, does it mean that the reader must learn or just have the knowledge? He must have reasonable knowledge. Must learn as in he does not need to have full knowledge. Okay. Let's just say if he's done with his IGCSEs, that's enough. Like he just needs to know what he's reading. He needs to be able to understand what he's reading, right? So he just needs to have reasonable knowledge. This is the only word you need to know. Like this is all you need to know. If they ask you in your paper one, then just write the users must have reasonable knowledge. And if they ask you in MCQ, then choose the option that says reasonable knowledge. I just dropped my stylus. Wow, the third time. Understanding how accounting works? Yes, exactly. No problem. Anyways, reasonable. Information should not be omitted from financial statements because it is decided it is too difficult for users to understand. So let's just say that right now I'm an IGCSE student, okay? Now Apple or some big company which has like a super duper cool financial statements decides to give me their financial statement, but they go like, yo, you will probably not understand what all this costing and financial and managerial accounting and stuff is, so we'll strike it off for you. No, you don't do that. No matter how dumb the person using this statement of financial using your financial statements is, you cannot just omit information from there because just because you think that yo it's too difficult for users to understand, you're not the person to decide that. Anyway, that's that. Now, two ways in which information can be regarded as being relevant. You know what? I'm also waiting for the answer for that. Let's have a look. Okay, this is activity 10.5. All right. Two ways in which information can be regarded as being relevant. The information must be provided in time for decisions to be made. By the way, this is to help the understand the concept of relevance because they barely give any information here and I did not understand anything. The information must be provided in time for decisions to be made. That's uh, if you have your info if your information is provided in time, if it is it's important that the information is provided in time. I already explained this part. Then it's relevant. Information must be capable of being used to confirm or correct prior expectations about past events. Information must help informing, revising, or confirming expectations about the future. I gave the bank example for this. You know, like if my bank wants to give me a loan, then they can use my financial information, financial statements, and the information in that to help informing expectations about the future, as in like, will I be able to pay the loan? Will I not be able to pay the loan back? Like that. Okay, then we have three ways in which information can be regarded as being reliable. Reliability. We have one, two, three, four, five, and they've just copied the same thing here. Explain why it is necessary to know any changes in accounting policy when comparing financial statements with those of a previous year. It is necessary to be aware of any changes to accounting policies and the effect of those changes. I mean, yeah, it's in simple words. I doubt I have to explain anything. If the changes are not taken into consideration, then comparison won't be easy and it won't provide meaningful information. So you can just say comparison will basically be useless because it doesn't do what we want. Explain the meaning of the term understandability means that financial statements must be capable of being understood by the users of those statements, assuming that they have a reasonable knowledge. Okay, so if they have a reasonable knowledge, my financial statement has to be easy enough to understand, assuming that they have a reasonable knowledge. Okay, so you shouldn't just put, I don't know, just we don't even need to know much. We just need to know that it has to be understandable by users of financial statements, and we also have to, assuming that they have a reasonable knowledge of accounting. Oh man, that was bad. Capital and revenue expenditure is easy, but like I'm just tired right now. Yo, what's going on? Why is my keyboard popping up out of nowhere? Could accountants embezzle money from clients without being caught? Yeah, they literally do it. What are you talking about? Could That's, like frauds and all of that stuff happens a lot. You mean like grade 9 or chapter 9? Or 9 subjects, okay, whatever. Anyways, should we end the class? I'm getting tired. It's been 1 hour. 1 hour of principles. Principles are bullshit. Okay, I think I'll just finish this chapter. So capital expenditure, money spent on non-current assets. Okay, capital is capital. All right, expenditure is spending money. Capital expenditure is spending money on purchasing, improving, or extending non-current assets. Okay, it's gonna be non-current assets, and you can just remember it as like capital expenditure is the big expenditure, and revenue expenditure is your normal small expenditure. Okay, let's look at examples. Purchase of non-current assets, cost of anything related to purchasing that asset. Okay, so if I'm purchasing the asset and like without the delivery cost, can I get the asset? I cannot. So I'll also calculate the delivery cost in your capital expenditure. And installing the non-current asset. If I purchase the non-current asset and I don't install it, can I use it? I cannot. So I install it, and there's a cost for that, and that will also be part of my capital expenditure. If there's any legal fees, without the legal fees, I cannot get the asset. I need the legal fees to pay to like use the asset, right? So I'll have to pay for that, and that will also be part of capital expenditure. Okay. Money spent by a business on purchasing non-current assets and improving or extending non-current assets. All right. So even if I'm renovating my entire office, it's gonna be capital expenditure. These costs will appear as non-current assets in the statement of financial position. They should not be charged as expenses because they benefit the business for several years. If you're buying a machinery, it's not really an expense. It's capital expenditure. It's capital. It will increase. It's increasing your capital. It will the benefit of that machine will last you several years, and that's why you won't just charge it as an expense in 1 year. Instead, you will put it as a non-current asset, and you will charge depreciation every year. Okay, so if let's just say it's $100,000, then you will charge depreciation $10,000 every year, and you will make the asset last for 10 years. Okay, as they benefit the business for several years. Okay, the value often decreases because of depreciation. This will be matched against the annual revenue which the non-current asset has helped the business earn. This is just stating the matching principle like in action, telling how the matching principle works. Now revenue, I'm pretty sure everybody understands capital expenditure. Now revenue expenditure is money spent on running a business on day-to-day basis, as in like paying for your rents, selling expenses, admin expenses, financial expenses, cost of maintaining and running non-current assets, like all your uh, repairs of your car, let's just say of your truck, of your motor vehicles, of your machinery, maintenance checks, and all of that stuff, like your day-to-day expenses, stuff that keeps happening more than once in a year. It also includes the cost of goods purchased for the purpose of resale. So it's basically every single thing that's not too expensive or that's not anything related to purchasing, improving, or extending a non-current asset. These costs will appear in the income statement and they are an expense, right? Because like your cost of goods sold, you put it separately in your trading section, but all of these, they're expenses. You just put them after gross profit, subtract them. If these two types of expenditure are treated incorrectly, the profit will be inaccurate and the statement of financial position, which will balance, will also be incorrect. So for example, if this is my capital expenditure, it's I bought a machinery, but if I put it as an expense, it will like understate my profit by a lot. Instead of having a $20,000 profit, if you put $100,000 machine as an expense, your profit will go from to a loss of $80,000. And like you're doing a loss of $80,000 in 1 year, and next year you're doing a $20,000 profit. That's not how it works, and that's like very weird. So that's why we keep capital expenditure separately, treat it as non-current assets in the statement of financial position, and we keep revenue expenditure separately. For the capital and revenue expenditure, not for the trial balance. This has nothing to do with the trial balance, but it has something to do with your statement of financial position and income statement. So both of your financial statements. Guys, if you want to talk, then just go in DMs. What do you say? Yes, exactly. Statement of financial position, balance sheet. It's just a different name, but like statement of financial position is just You could say the updated name or something. All right. Now, treating them incorrectly will give you a wrong balance sheet and a wrong income statement, a wrong profit, and I just explained why. All right. If repairs were treated as an improvement to the machine, the expenses in its income statement would be understated. So if I'm doing repairs to a machine, normally it's an expense because I'm maintaining and running the non-current asset. But if I treat this improvement, this repairs as a non-current asset, then my non-current assets are overstated, meaning that they're written more than their value, and my expenses are understated, meaning that they should have been more, but they're less now. So the profit would be overstated because if you have lesser expenses, then your profit would be increased, right? But this is falsely increasing. The statement of financial position, the non-current assets would be overstated, and capital would also be overstated because of the wrong profit. So you see, just like doing, just mixing the capital expenditure and revenue expenditure is affecting your capital, is affecting your statement of financial position, is affecting your expenses, and it's affecting your profit as well. So one small mistake and 4 marks. Crazy, but mostly you'll just be saved by OF, at least, hopefully. Uh, Capital receipt is when money is received other than normal trading activities. Normal trading activities, as in your buying and selling of goods, all right, or your discount received, commission received, interest received, all of that normal stuff. Yeah, but like the video is being recorded, you guys are just here for the fun of it. In my head, we find out. So this includes the receipt of capital from the owner. Capital receipt, of course, like if you're investing capital into the business, that's also capital receipt. Receipt of loans and proceeds of sale of a non-current asset. If you're selling your non-current asset, say I have a machinery, I bought it for 100,000, I used it for 300 years, and now I want to sell it. I sell it for $30. So this $30 is capital receipt because I'm making it from by selling a non-current asset. Okay, and then there is receipt of loans. I don't know what this means. I can say, like, you can say that it's the amount you receive in a loan, sure, but I think that's a liability. Wait, what's the definition for capital receipt? Money received. Yeah, so if you take a loan from the bank, that's also capital receipt. Crazy. I didn't know that, but now I do. All right. Revenue receipt is money received by normal activities, normal trading activities. Oh, by the way, the capital receipt should not be entered in the income statement because this is not exactly your income. I mean, you know, but a profit or loss is made on the sale of non-current asset will be included in the income statement. So you know how I just said that I bought a machine for 100,000, used it for 300 years, and after applying depreciation and all, the value of the machine was $0, but then I sold it for $30. So I made a profit of $30 on this machine, right? So I'm gonna put this profit only in the income statement, all right? But normally it's not really $0. Let's just say that the machine was valued. I used it for 3 years, and then it was valued at 20,000 and I sold it for 22,000. So I made a profit of only $2,000, so I'll record $2,000 in the income statement. Does that make sense? Commission received is revenue receipts. Yes, capital receipt is for things with big number. It does not have to be big number. Capital receipt will be in the balance sheet. Yes, exactly. One second, bro. One second. One second. One second. No, no, no. Who said the capital receipt is in the balance sheet? Who said that? The capital receipt, if you're receiving the money, then it's gonna be recorded in the cash book and stuff. Okay, this me receiving this 22,000, I'm gonna debit the cash book. Me receiving the loan, I'm gonna debit the cash book. Me receiving capital, I'm gonna debit the cash book. Okay, or if it's in form of machinery, then I'm gonna debit the machinery, the asset account. All right, but you're not gonna write it in the balance sheet because this is not your asset or a liability. I mean, like, this is a liability, so you're gonna put it in the balance sheet. This is capital, you're gonna put it in the balance sheet. This is, you're removing your non-current assets, so you're just gonna subtract your total non-current assets. You won't really show it in the balance sheet, but you're gonna reduce your non-current assets because they're going away. The point here is that it should not be entered in the income statement. Okay, Why not? If I sold it for 22,000, it does not mean I made a revenue. I did not make an income of 22,000. I will not record in my income statement 22,000. I'll only record 2,000 because that's a profit. And if it's a loss, say I sold it for 18,000, the net book value was 20,000, but I sold it for 18,000, so I made a loss of 2,000. You will also put that in the income statement. Okay? Tuck. Now, revenue receipt, money you receive from your normal stuff, sale of goods, fees from clients, other income, maybe your rent received, commission received, discount received, because this is your normal trading activities. This is like what you do normally. Overstage, 1 minute. Because of like big number, you don't really remember it like that, but sure, it's gonna work for some time, at least in IGCSE probably. It overstates your assets and brachis prudence principle. What exactly are you talking about? Capital receipt being recorded as your in the balance sheet would overstate your assets, yes, if you record capital receipt in the balance sheet. If you make a loss, it goes to income statement, and if you make a profit, it also goes to the income statement for what you want. Were you not focusing by any chance? Anyways, that's that. Now we have come to inventory valuation. Oh, you're slow, I can tell. Anyway, explain why it is important to distinguish between capital expenditure and revenue expenditure. Because, bro, if you do not distinguish it with one mistake, you're gonna make one, two, three, four mistakes, and that's not a very cool thing. This is basically the answer to all of that. One example of each of the following: a capital receipt and a revenue receipt. Capital receipt, you can just say me selling my Bugatti and receiving the money. Like this Bugatti must be part of the business, okay? So if you're selling a motor vehicle and then you receive money on that, that's capital receipt. Revenue receipt is me making sales, or me getting discount receipt, commission receipt, rent receipt, sale of good fees from clients, any other income. Okay, I will. You can't. Even if you can, you can't do anything to me. Mm, I'm confident about that. Very. All right, that's that. Now we have come to inventory valuation. Okay, honestly, I don't know what I should do. Should I end the class or should I do this? Because it's kind of a important concept. If I do it right now, I might just rush it. It's 5:45. I have other things to do. And trade doesn't appear in the index. I should rush it. Have you done this chapter ever before?
Ah, man,
Life?
no one can understand it if we talking in rush.
What?
No one is going to understand, bro.
Yeah,
I promise
exactly.
you.
I
If we
can
are,
rush. I
if
can
you
rush. I don't mind. It took me 1 hour and 8 minutes to do it. All of this, I could have done this in 10 minutes. But what would I have done? I would have just read the definitions and just read stuff instead of explaining it, and just read the definitions, give
okay, but
one example or something. But like I'm yapping, so if I don't yap over
okay,
here, it's an important concept. So it's hard as well. It's not so easy. Profit made or loss taken from selling goes into the income statement. Yes, revenue receipt is everything, pretty much. I have it. Okay, you should rush it. I said, you know, I literally can. No, never mind. I cannot. I'm busy right now. I've got things to do. But me covering the entire syllabus in one day is not the first time. I've done that before, and I even recorded it. I will find a way, and don't worry. I am woman with lot of weird comrades. I am will. No, you're not. I only study until control account. I already done this the syllabus speedrun. Oh yeah, well it wasn't all recorded because I recorded it, but then the recording was kind of lost. Anyway, inventory valuation. Now, inventory has this one concept, you could say, or one statement, and this thing will just memorize it. Inventory will always be valued at lower of cost and net realizable value. Khalas. Just like you need to understand it, but make sure you know it, make sure you have it memorized, because in MCQ they ask you this. I only Alright, but just give me a minute. Uh, wow, wow, that's crazy. All I know is use the lowest cost between net or valued. Actually, you're gonna get cooked if you only remember that. Anyway, I hope you don't. Probably might get cooked though, but like it's okay. It's gonna be okay. Everything's gonna be okay. So lower of cost and net realizable value. Now net realizable value is the only new concept here. Cost is basically the cost at which you bought the inventory. Now, why do we do this? This is because of the prudence principle. If you do not value it at the lower of cost or net realizable value, you're basically overstating or overvaluing the inventory. And prudence principle says do not overvalue your assets. Okay, if you overvalue your inventory, your profit and the assets are to be overvalued, which is not a nice thing. Prudence is not like that. The cost of inventory is the actual purchase price, all right, plus any additional costs such as carriage inwards, all right, incurred in bringing the inventory to its present position and condition. So, cost, lower of cost over here, when you say cost, you don't just mean the purchasing price, you mean purchase price plus additional costs, maybe carriage inwards, or any costs to bring the inventory to its present position and condition. Say my inventory is damaged. Say I bought 100 goods and each of them were of $2. Okay, I have $200 goods. Now out of this, 10 goods were damaged, and to repair them, it took me $0.5 per good. So in total, that makes $5 extra. So the cost of these 10 damaged goods is not $2 now, it's $2.5 now. Okay, because to bring them into sellable condition, I had to bring it, I had to put this expense. Okay, next, the net realizable value is the estimated receipts from the sale of the inventory, means like your expected selling price, less any costs of completing the goods or cost of selling the goods. So you can just say expected selling price minus selling expenses. Okay, not the net book value, bro. Net book value is different. Net book value is found by subtracting repair fees from the resale price. You can't rage bait me, bro. I have a younger brother. Net realizable value, yes. Okay. The net realizable value is the estimated receipts from the sale of the inventory less any cost. I don't like to explain stuff with theory. I like to explain stuff with examples. And me reading the textbook and explaining stuff is kind of lame. But like, I don't know, explaining it on a plain white paper would be kind of more boring because I've done that in my previous sessions though. Nobody, I mean, yeah. Well, that was different. Anyway, so usually the cost of inventory will be lower than the net realizable value. It may happen that the goods are damaged or there is no demand for such type of goods because of the change in taste or fashion. In this situation, the net realizable will be lower than the cost. So they're just saying that cost is mostly lower, but sometimes something can happen and net realizable value will be lower. Okay, whichever one is lower, you're gonna take that price. Okay, you're gonna take that cost. You're gonna take that value, not cost. You're gonna take that value. All right, now I will sell two type of different goods provided the following information: type A, type B, cost price, and net realizable value. So for type A, 20 or 18, this one is lower, you're going to choose this. And then 15 or 19, 15 is lower, you're going to choose this. Okay. Type A does not include carriage inwards, $1 per unit. So you're going to go to type A and then cost. Where do you add carriage inwards? You add carriage inwards in cost plus 1. So now this is not 20 but 21. It will cost 0.5 to bring to per unit to bring type A into a sellable condition. Now, wait, what? Oh yeah, selling price minus selling expense. Now you see this is a selling expense. You need to incur this cost to be able to sell type A goods, right? You need to bring this you need to spend 0.5 per unit on type A goods. And what is net realizable value over here by definition? Net realizable value is estimated receipts from the sale of the inventory, which is like selling price, less minus any cost of completing the goods or cost of selling the goods. So in this case, we need to complete the goods to bring them into sellable condition, or the cost of selling the goods is 0.5. So we do minus 0.5, which is 18 minus 0.5, which will make us 17.5. Now tell me which one is lower, 21 or 17.5? Of course, it's 17.5, so we're going to use that. Now 12 units of type B were damaged and would only be sold for $10 per unit. No way. Uh, It sounded like he made a beer of sausages. No, I don't drink that stuff. Well, lateralizable, of course. Why do you think I'm teaching it? It's like asking, will accounting come in my accounting exam? Anyways, 12 units of type B were damaged and would only be able to sold for $10 per unit. So we have type B, 38 units. Cost price 15, net realizable value is this much. Now give me a minute. If I want you guys to answer this to me, over here one of them becomes 10. Okay, so like there's type B, there's 12 goods and the value is 10, but is this going to be the cost or is this going to be the net realizable value? Or wait, let's change it. Cost and net realizable value. Tell me, can any of you tell me the answer? Went back and no one called me. Yeah, we can tell. You never know, maybe there'll be noise shows. I wasn't. Is anybody giving the answer or should I just move on? Basically, they have this 12 units of type B were damaged. This part that I've underlined. I want you to tell me, will this $10 be the cost or net realizable value? Like, how will you adjust for this $10? What cost? Are you? Yeah, 10 is the net realizable value. This guy is smart. Okay, good job, good job. So, why is it the net realizable value? Because the definition, by definition, net realizable value is. Well, by definition, net realizable value is the estimated receipts from the sale of the inventory, which is the selling price. And now here, estimated selling price is $10 per unit. So their cost is still 15. Nothing happened to that. But the net realizable value became $10. What is lower, 15 or 10? 10 is lower. So you do 10 into 12 and you do 26 at 15 because 15 is lower than 19. So you choose this, and you choose this. 17.5 to 94, and then you get your inventory valued. Okay, this is how you value your inventory. And then this is the explanation: 20 plus 21, 18 minus 0.5, your selling price minus costs to bring it to selling condition. And then oh yeah, anyway, back on the topic. I like ice cream if it's free. Yeah, about the question, back to the topic. About the ice cream question. Mm, yeah, who's fighting? Anyways, so here it's valued at net realizable value, which is 17.5. Here it's valued at realizable value, which is 10. Here is value that is 15. Blah, 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 blah. Okay. Now, as explained earlier, the inventory. Bro, let's just skip this reset. Oh yeah, start. Did you just say you didn't understand this? Yeah, you were right about being slow. This okay. Now we did this in like chapter, I don't know, 2 or 3 or something like that. That the closing inventory, when we were doing trial balance, that's when we did this. That the closing inventory of 1 year becomes the opening inventory of the next year. So if an incorrect value is placed on the inventory, it will affect the gross profit and profit for the year. Because when you want to calculate your gross profit, you have to find cost of sales, and to find cost of goods sold, you have to use opening inventory, closing inventory both. So if you mess up one of them, you're gonna mess up your profit, your gross profit, your capital, and you're gonna mess up your entire life, and everything is gonna get messed up, and then you probably die a single. Okay, if any correct value is placed on the inventory, it will affect the gross profit and profit for the year for both the current financial year and the following financial year, because it affects the opening inventory at the start, and then next year it also affects the opening inventory, like if it affects the closing inventory of this year and the opening inventory of the next year, because that's the same thing. Okay, incorrect values will also be shown for both current assets and capital in the statement of financial position, meaning you even made your current assets wrong, overstated them, and then your capital, you did something wrong with it. Anyway, after the preparation of his financial statements for the year ended, Dhawan discovered that he had overvalued his closing inventory by $50. Now, this this is something I don't feel like explaining. It's important, but I'm just tired. I'm not tired, but like I'm tired. Alright, I'm just speaking. Calculation, the problem is easy. Okay, opening inventory is added to cost of sales while closing inventory is subtracted from profit. Opening inventory is expressed. What do you mean? Yo, what do you mean? No, what are you trying to say? From where? Both of them are assets, but they're just taken at the closing date. Like opening inventory of this year was the closing inventory of last year, so it was an asset of last year, but they're not an expense. Save my exam, bro. I don't know. Well, I guess I'll just explain this for you guys, or whatever. Okay, gross profit for the year. So, nah, bro, this is too much effort. Closing inventory overvalued. They probably just given it here. I'll just read it. You guys understand it on your own. Cost of sales is understated, so the gross profit and profit for the year will be understated. Overstating the profit for the year. Okay, what the heck? We just do this tomorrow, right? We're gonna continue from here tomorrow. I don't wanna not explain it nicely. I wanna explain it nicely, but like I don't wanna take it. I don't wanna take too much time. All right. So yeah. Bye.